Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is your host, Steve Meizinger, and today I'm pleased to have Mark Abssy with the ISE webinar series. Now, normally I am the host, sometimes the presenter, but today I'm pleased that we have Mark Abssy, the Index and ETF Manager for the ISE, and Mark is going to be talking about ISE's unique suite of proprietary index as well as the first trust and Direxion ETFs listed on them. So this is the first of many webinars that will be focusing on ETFs and index trading strategies. Today, really not talking a lot about option strategies, more of a background of concepts of risk, asset allocation, beta diversification, and then we will move on to basic ETF options terminology, and then we'll go into some strategies in the following weeks. So again, I'm really pleased to be delivering this program, brand new, and we'll be doing it just about every Tuesday, although next week it will be a Wednesday. But I think that it's going to be very, very popular. As we know, ETFs are very, very popular. So without further ado, why don't we get started? I'd urge all of you to get a copy of the characteristics and risks of standardized options. You can get it through your broker. You can go to the Options Clearing Corp, go to optionseducation.org. It's very, very important so you understand the risks of options. Of course, and I think we all try to teach the risks and rewards, but it's really very, very important to read that document. So please do it as early as possible. As I said, I'm not going to talk a lot about option strategies today. That will be for subsequent webinars. But suffice to say that there are strategies for any kind of market, bullish, bearish, neutral, even you could be neutral on the market and be predicting volatility. That might be a great strategy for someone that is looking for something that might happen, but you're not really sure which way, so whether it's a straddle or a triangle. We're going to handle most of these option strategies over the following months, but please stay tuned. Today is just an intro to the ETF and ISE indexes. So what's risk? Well, risk can be defined in many different ways. You can look at asset allocation. You could look at the concept beta. Diversification with ETFs, that's really, again, another thing we're going to go through. So risk, asset allocation, betas and portfolios, diversification with ETFs, and then we'll have a brief summary. I'm lucky enough to have Mark Abssy with us today, and Mark is a manager of ETFs and indexes at the ISE, so he helps build these index products, and I think that you will gain great insight into that marketplace. You can type in a question now, and Mark will handle some of the questions at the end. So if you have any questions, please just type them in the chat box. Just want to make sure the sound is indeed working, so I hope that everybody can hear me. Just type a Y so that I know that the sound is working. Good, 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 good. And if you don't have sound, you can always use the conference. You go up to communicate, and you can actually call in and get a specific number. But I'm glad most of you can hear me, and then Mark on your speakers, using your speakers. So what is risk? Well, people look at risk a lot of different ways. The potential for loss, the probability of losing money, and it's the market's perception of risk that prices all the asset classes each and every day. Systematic risk, also called market risk, and unsystematic risk, which is unique to individual securities. So as we went on the webinar today, we knew that we had IBM earnings that were coming. We knew that Apple was coming. That would be one type of unsystematic risk. So it's diversifiable risk. You can buy certain assets, buy certain companies, or you can get into ETFs and try to create a more a portfolio approach, that is up to you. And please, if you have any questions, I see the questions are already coming in to Mark Abssy, who is the resident expert at the ISE on indexes and ETFs. Please type any question, and Mark will handle those questions at the end.
Sorry, Steve.
Yeah, Mark.
The only thing is, unfortunately, this version of WebEx that I have, I seem to not really be part of the whole group here. So I'm unfortunately not seeing. In fact, I'm seeing you and me. But perhaps at the end, Steve, you could read out some of those questions. I can.
Absolutely. Sorry, Mark. Yes, you're right. I understand that. Yes, I will read the questions to you, Mark, and yes, Mark can handle the questions.
Okay. All right.
So when we talk about exposure and uncertainty, well, it's either measurable or unmeasurable. And the unmeasurable part is obviously the thing that we're scared about when we're trading is that, when you're trading, there's a potential for things that you just cannot really fathom as far as the market dropping a certain amount, or if you were short the market rising a certain amount. So we like to think we can measure most of the exposure. The honest fact is that some of it is really uncertainty that we cannot really accurately predict. Again, ETFs and indexes are going to help you understand or actually diversify some of that risk if you'd like. Markets are dynamic. Theoretically, at least this is the academic basis of the markets, is that we trade these assets based on future cash flows. Why do certain markets move a certain way? Well, or more than you'd expect? Well, it is based on perception. So if we all feel that a certain event's going to occur and actually turns out to be the reverse of what we're all expecting, we could see a cascade effect. And we saw that, I guess, through 2008 and early 2009. Although recently we've seen a lot less volatility, and the market's been moving up steadily, at least in many asset classes. We as traders, investors, should be cognizant of the potential for volatile periods. We're not seeing that now. In fact, the market is obviously very, very quiet. It doesn't have to remain to that degree, but please just consider the potential that markets can move in very uncertain ways, and our investment strategies should be flexible as the markets trade in non-perfect forms. We look at, many of us are mathematicians, so we look at standard deviations, the idea that we can get a mean of where the market is today, and then come up with standard deviations. I like to call them error factors from that average. But again, they're just expectations. There's nothing written in stone that says that a certain standard deviation has to be correct. It's just an error factor from what we'd expect. In fact, one of my favorite quotes is from a gentleman, George Pelham-Bach, the famous statistician, who once remarked essentially that all models are wrong, but some are useful. Robert's saying that Apple is halted as expected. They beat estimates, so we'll see what that all means. Just to keep everybody abreast of what's happening, I believe in all my years of trading, I've been in the markets for about 30 years, and I think that flexibility is very, very important. That's how I've been able to survive through markets that were very, very turbulent. So you should try to adjust to market conditions, find investment strategies that meet your own goals and your own risk tolerances. Hopefully, the ISE indexes and the ETFs might be part of that overall portfolio. So when I look at asset allocation, there are many things that you might be investing in, such as equities, ETFs, equity indexes, fixed income, we call them bonds, of course, options, money market, which is, of course, cash, currencies. We also trade currency options at the ISE, real estate investment trusts, and commodities. Those are just, I guess those are more popular ones. There are others. The modern portfolio theory, MPT, is based on the principle which attempts to maximize investment returns and minimize risk by carefully choosing different assets. So there is a theory that says that you should try to balance your risky assets and your safer assets to create a more efficient portfolio, and ETFs can help you, and indexes might be able to help you on using this modern portfolio theory. Investors that are seeking higher returns will be required to choose riskier assets, and risk might be defined as the deviation of return. That's just one way to look at risk. So getting more into that MPT, what is the optimum portfolio with a weighted combination of various assets so the expected return is the weighted average of the asset's return? So the goal is to find assets that are quote-unquote attractively priced, or what I would say cheap, relative to other assets. Again, not only the price of those assets, but correlation, so how assets would move relative to each other. The theory states that some assets should be moving up while others be moving down. But if you implement these correctly, your gainers should exceed your losers, giving investors a net positive theoretical return.
Yeah, one of the things there, Steve, that I'd like to add is, you know, one of the great things that ETFs have allowed investors to do is to really branch off from traditional long equity, whether it be domestic or international equities. And in doing so, it's actually given them a lot more tools to expand on this idea of diversification. And I'll just take a quick moment here. You know, one of the things when you look at invested, say, domestic equity assets, right? Basically, the bulk of them are tied to either the S&P 500 or one of the various, you know, style benchmarks offered by Russell, right? When you look at, as Steve was just saying, the correlation of all of those indexes together, they're all very high. I mean, let's not forget that part of what Russell was trying to do here was trying to take kind of market share away from S&P with the 500 in creating the Russell 1000 and then the rest of the family, both in style and size. So they wanted to make an index which was going to be, you know, better than SPX. Well, they did so to a certain extent, and in fact, when you look at assets that are managed under the Russell indexes and then SPX in total, it's about, I don't know, we'll call it $4.5 trillion. When you look at the matrix, at the correlation matrix of all those indexes together, especially the Russell, there's some very high numbers in there, 0.77, 0.93, 0.89. Very high correlations with all of these indexes. So you hear a lot of people talking about growth and value, large and small, this versus that, etc. There's really not that. There is diversification among all those classes, but when you in turn look at assets that you can get exposure to via ETFs, which again is SPX, but also, you know, EFA, emerging markets, oil. You know, I'll still call it the Lehman Ag because it'll always be the Lehman Ag to me, but, you know, the Ag, REITs, currencies, commodities. You look at these correlations, you know, 0.37, negative 0.057. I mean, these are low numbers. These are really the kind of numbers that you want to look at because you're truly looking at very near or very close to uncorrelated or in some cases even negatively correlated assets. So, you know, again, just to reiterate, ETFs give you a broader range of choices, and with those choices, not only you can make interesting mixes, but also, you know, useful, better uncorrelated baskets. So
Mark, so for a lot of us, maybe we're not trying to replicate the S&P 500, but maybe trying to move away from that. Is that what you're saying? Where correlation can help you?
Yeah, I mean, you know, over the last few years, you know, the big buzz has been hedge funds and hedge fund-like returns and all of these sorts of things. You know, when you look at what you can get exposure to now via ETFs, geez, 5, even 7 years ago, a lot of that was, yeah, I'm sure there's some guy in Connecticut who's sitting on $1 billion, you know, who can get access to those markets. It's like, well, no, not anymore. It's anybody with an E-Trade account or, you know, Fidelity account or something can just go and say, oh, I think I want to do some kind of gold oil trade. Okay, well, you can do that, and it's real easy, you know, and you can do it in the cash market. You can do it in the options market even. So it's really blown open, you know, the ability for all kinds of investors to really take advantage of truly, all the markets that are out there.
Very interesting. That does make a lot of sense. So risk and reward, I mean, essentially what Mark is saying is that we all should really do our homework and think about where we have our assets and how we can actually do it a little more efficiently. And there are probably indexes and ETFs out there that might give us a nice way to look at assets that are not correlated with each other. If you look at that slide 14, I guess that's my point, is that we have the familiar Sharpe ratio, which measures risk-reward beyond treasuries. And essentially what a lot of this, at least the theory says, is that we should be along this efficient frontier. If you wanted to be above that, you would take more risk. If you're below that, maybe your portfolio is actually underperforming because you're just not on the sweet spot of taking enough risk versus reward. So you look at the X and Y axis, looking at the rate of return, higher returns, of course, with taking more risk. And if you look theoretically, the X-axis, you see standard deviation, more risk. So as Mark pointed out, correlation can help us. If we find assets that are not necessarily correlated with each other, we might be able to sort of fit more comfortably, more efficiently on that frontier. Does that make sense, Mark, to you?
Yes, yeah.
Okay, perfect. All right, so I guess it's more the same on the next slide, the efficient portfolio. And I guess it comes back to the same concept again, is look at the various assets that are available, and there are indexes and ETFs out there that you might be able to fit into your portfolio. And so I'm glad that Mark and I are glad that you're with us today, and hopefully for all the subsequent webinars, we'll talk about different ways to look at to invest with indexes and ETFs. So what's a beta? Well, I get this question very, very often in the options presentations that I deliver, and I try to remind options traders that, well, beta is something that when we look at equity or as far as investments, you're looking at a risk level of an asset versus, as Mark said, a benchmark. Normally the S&P 500, but it could be other benchmarks. And the beta is just going to tell us how, at least theoretically, how much your, or whatever portfolio you're looking at relative to the S&P 500, how much it should move. So if you had a beta 1, it should be moving exactly like, for example, the SPY or the S&P 500. If you had something that was 2 or 3, that might be a high-tech stock or a biotech stock or something like that, or even smaller indexes in emerging countries or whatever, they might have much higher betas. But again, the options world, we don't look at this, but when you're looking at indexes themselves, this is something that's very, very relevant. Mark, do you have any points to add as far as beta?
Yeah, I mean, I think that a lot of people got introduced to beta very abruptly toward the end of '08 when Direxion started the bulk of their business and started offering, well, I mean, Pro shares, of course, have been in the business for some times with their Ultra Bear and Ultra Bull products, but this idea of a 3 times levered product, these are essentially, 2 and 3 beta products. And, as everyone's been talking about in the last year or so, the only thing that I can't stress enough about levered products, about inverse products, is to really pay attention as to what the product says it's going to deliver to you. When the 3 times products first came out, there was a, let's say, a misconception, some might say a miscommunication, but there was a misconception in the marketplace that these were buy and hold products. Investors quickly learned that was not the case, and Direxion and the industry as a whole has actually done a pretty good job in educating investors that, look, these are not buy and hold instruments. These are trading instruments in which if you have conviction in market movements, whether it be in financials, energy, broad market, etc., these are tools that can let you really take advantage of that. Now, in the last little while, we've seen filings and some issuance of multi-beta products, 2 and 3 times products, which are based on a 1-month swap reset instead of a daily. And so, the people, or rather issuers, are getting a little more advanced in what they can do and what they are able to bring out. I don't know, I guess that's about it. I just wanted to, again, couldn't stress enough that, when you are buying a product, especially something that's relatively new to the marketplace, especially that's something that involves leverage, please be sure that you understand what the product is saying that it can do for you.
Excellent point, Mark. That's an excellent point. I've actually handled that questions in option seminars, countless times. Somebody that said they were, let's say, long the triple long and the triple short, and thought they had a straddle on, or actually thought they had a great position for the long term. And as you pointed out, Mark, maybe you do if you felt that the market was going to make a big move in the next day or two, but to hold that over, a very, very long period of time is probably not what you'd like to do. You should be doing. All right, let's move on. So that's a little bit about beta. Reducing portfolio risk. Well, beta helps you at least get a reasonably good idea of how much that portfolio might be moving relative to the benchmark. So again, if you had another portfolio that had a beta of 1, it should be moving pretty much like the benchmark if it was the S&P 500 or any other benchmark. But you have to really decide what kind of beta you're looking for and what are your goals. And not only that, but what are your risk tolerances. How can you cushion yourself from underperformance? And we want overperformance, but overperformance also means some risk. So we need to think about that also. Correlation. It's really there's a lot of ways to define correlation, but it's the relationship between assets, how they move with each other. Normally, we look at linear regression, measuring correlation. So positive correlation means that assets are going to move in a similar fashion. And negative correlation might be that, or is that we have an inverse relationship. So if you looked at airline stocks and oil stocks, you probably would see a negative correlation, and you might see a positive correlation, let's say the Australian dollar and gold, for example. The Australian dollar and the S&P 500, recently, there's been a very strong correlation. And these correlations can change. Mark, anything you'd like to add regarding correlation?
No, I mean, I spoke about it a little earlier. Again, lots of ability to structure all kinds of trades based on the correlation of various assets. One of the good things about, again, what ETFs have done is just opened up a lot of different areas, a lot of different asset classes to people. So, again, gold, even gold in USD is still pretty attractive in terms of negative correlation. There is a lot of data out there, and there are lots of products out there that can let you construct some pretty creative and useful strategies. So,
thank you. Diversification. The simple concept there is that you might want to buy groups of stocks rather than just one stock. Creating more efficient portfolios by reducing this correlation risk. You need to think about costs. Trading costs are higher, so commissions and even bid-ask spreads. I'm always, whenever I'm teaching an option seminar, talking about risk and reward. When you're looking at currencies, I know a lot of you join us for our currency webinars. A lot of the guests talk about risk aversion, risk appetite, and I like to say it's the return of my money versus the return on my money. We sort of go back and forth on that point. Is that, sometimes we say, we want a risk appetite and we're looking at return on my money, but then during the depths of the 2008 crisis, we were saying, wow, we want to avert risk, and the return of my money is all we really care about. So those are two polar opposites, and I think helps all of us remind ourselves of investments in general, whether they're indexes, ETFs, or just plain old equities, and just keep that in mind. You should always consider your own goals and your own risk tolerances, trying to balance safety, growth, and income. I know it's much easier said than done, but at least that's the theory behind it.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.